Hello, everyone. Thank you for joining for today's webinar on understanding the expanded benefits of energy tax incentives under 179D and 45L. My name is Mark Cooter, and I'm a partner and leader in the real estate and construction group with Cherry Bekaert. We've got a couple of house cleaning items to take care of before we get started. We are offering 1 hour CPE for today's session. Here's a few items to note before we get started. To receive CPE credit, you must answer at least 3 of the 4 polling questions and attend for the full 50 minutes. CPE certificates will be issued via email within 10 days. If you have not received yours after 10 days, please email cbhlearning@cbh.com. A recorded version of this webinar will be available in about 1 week and will be sent via email posted to our website. If you have any questions during the webinar, please type them in the Q&A window. Just note, a short survey will be posted at the conclusion of the webinar, and we'd appreciate your feedback at the end of the webinar. So let's get started with the first poll question. Please submit your answer on how you've heard about the webinar today. A reminder, your CPE must answer 3 of the 4 questions. We're going to give you about 1 minute to respond to this, but we'd love to hear how you've heard about today's webinar. All right. We will, thanks everyone, appreciate that. And we'll tally those results. I'm pleased to introduce our speakers today. Ron Wainwright, partner with Cherry Bekaert in our Tax Credit and Incentives Advisory Group, along with manager Bill Harbison. We also have Victor Jones, principal with Jenkins Peer Architects, joining our panel today. So with that, I'm going to ask Ron to take it away.
Very good, Mark. And thank you all for attending today's webinar. We're excited to present this information to you, and we believe it to be very relevant and a lot of changes, as you all may know. So the first polling question, are you familiar with the 179 Cap D tax deduction? A, very familiar, B, somewhat familiar, or C, not familiar at all. We'll give you about 1 minute, but please complete. All right, thank you for answering polling question number 2. So let's begin with a little bit of background before we do the deep dive into 179 Cap D and 45L. So both of these provisions were expanded significantly underneath the Inflation Reduction Act of 2022. This was a result of really a surprise agreement between Senator Manchin and Senator Schumer in late July that ultimately paved the way for President Biden to sign the Inflation Reduction Act of 2022 into law on August 16th. From an income tax perspective, as a point of information, the act includes significant tax credits and incentives covering a broad category of clean energy initiatives, as well as it also includes key revenue raisers, which we will not discuss today. As a broad perspective, what we saw within the Inflation Reduction Act was really an extension of existing credits and deductions, and key provisions of the act and enhancing existing tax credits, specifically in the clean energy space. The act is often referred to as the Green Energy, the Sustainability Act, or the Clean Energy Act. But in the expansion, there are 2 key points, the 45L, which we'll discuss today, and 179 Cap D. From a stance, it was expanded as well as enhanced. Most of the provisions take effect January 1 of 2023, and the Inflation Reduction Act was really almost a remnant of what was the Build Back Better plan, a la the brokered agreement between Senator Manchin and Senator Schumer, because we know that that's where Build Back Better died. Again, multitude of clean energy credits and deductions. Today, we will not be able to discuss a broad array other than 179 Cap D and 45L. So for background purposes, Section 45L is an energy efficient home construction credit. It was really retroactively put back in the statute as it lapsed effective for the year 2022, but now it has been expanded and extended through 2032. The Inflation Reduction Act actually is permanent law through 2032. In Section 179, it's the energy efficient commercial building deduction. And what we saw there at a very high level was a modified formula, which we'll do a deep dive into, to really determine the eligibility for new construction. And then we also saw really a new deduction added for what was referred to as kind of the retrofit of property, and then really a reset where you can earn 179 Cap D multiple times. So let's get into a deep dive. And now I'd like to turn it over to my teammate, Bill Harbison. And Bill, why don't you walk us through some of the detail on 179 Cap D?
Absolutely. And thanks, Ron, and thanks, Mark, as well for having us. As Ron mentioned earlier, a lot of exciting changes as part of the Inflation Reduction Acts, particularly for both 179D and 45L. So some recent updates for 179D. Of course, it was made permanent as part of the CARES Act of 2020. But then in August, when the Inflation Reduction Act passed, some substantial changes, overhauls, expansions to the incentive were part of that legislation. These changes to 179D will take effect for buildings placed into service in 2023. And we'll talk in a little bit about what it means to be placed into service. Perhaps most importantly, certainly most excitingly, is increase the maximum available deduction that's going to be available. Excuse me. Also, some new prevailing wage and apprenticeship program requirements, which we'll discuss. Updates to the modeling standards and methodologies. Of course, an additional way to qualify for the deduction using an alternative calculation method. Expansion of eligible buildings, which again is another very exciting area for us, as well as a triennial reset of the deduction. And we'll get into some detail here in a little bit. Ron.
So as we discussed, when we think about updates to energy efficiency commercial building deduction, 179 Cap D, but it's also applicable to 45L, which we'll speak about, the new prevailing wage and apprenticeship program requirements. So in somewhat late breaking news, on November 30th, the Treasury Department, as well as the IRS, issued Notice 2261. It's the prevailing wage and apprenticeship initial guidance under Section 45 and other substantially similar provisions. What the notice tells us or provides is information and guidance on how business taxpayers can meet the requirements to qualify for maximum benefits of the 179 and 45L provisions. The notice defines what constitutes a prevailing wage as an employee earning this wage with respect to, as well as a qualified apprenticeship program, and also provides some examples. So let's take a little bit of a deeper dive in this update. So when we think about the prevailing wage so that we can earn that bonus from 179 Cap D up to $5 a square foot, and then under 45L to $5,000 per unit, the notice around the prevailing wage requirement applies to wages paid to laborers as well as mechanics employed by the taxpayer or any contractor or subcontractor of the taxpayer during the construction of a qualified building or a facility. The wages paid to these workers must be at rates no less than what is referred to as the prevailing wage for a construction, alteration, or repair or similar character in the locality in which the building or the facility is located. Now, the Secretary of Labor publishes prevailing wages And an individual laborer mechanic that is paid this prevailing rate can be classified as employee or as an independent contractor as well for other federal tax purposes. So as we look to make sure we're maximizing that bonus, again, from the $1.88 old law to now $5 per square foot of 179 Cap D, or old law of 2,000 per unit, now to 5,000 per unit in 45L, it's going to be very important to look at that prevailing wage. Now, when we think about the apprenticeship program, what the notice told us was that taxpayers, to satisfy the apprenticeship program, have various requirements when hours are worked by qualified apprentices, making a set percentage of the total hours of the work performed on the construction project. So what the notice told us was the percentage of qualified apprentice hours to total hours really vary now based upon the date of construction. And the date of construction is when it begins. So let's think, before January 1 of 2023, that apprenticeship hour requirement is 10%. As we look over the horizon after 2022, and really before January 1 of 24, it's 12.5%. And then on or after January 1 of 24, it moves to 15%. So again, the apprenticeship requirement applies. Remember, it's new prevailing wage and apprenticeship program requirements. So it applies to taxpayers and contractors and subcontractors of the taxpayer. Now, one of the key questions here, just as an update, is going to be, well, what is the documentation that I need within to make sure that I am earning the bonus? And so what the notice tells us and clearly states is that the taxpayer claiming the benefit under 179 Cap D or 45L is responsible for documenting and maintaining records to show the prevailing wage and the apprenticeship requirements are met based on the standards. Now, documentation does include wages paid and hours worked for the taxpayer, and wages paid and hours worked for its contractors and subcontractors. So what are the next steps, just to move on to the other updates? The title of the notice that was published, again, November 30th, is interesting. It does state that this is the initial guidance. So taxpayers can expect additional guidance to be developed and regulations which will be issued as the Treasury Department and the IRS receive input from the taxpayers, because it's in an open period. So now let's move on.
So just a quick history for those people who weren't familiar with 179D previously. Up until very recently, the maximum available deduction for a building was $1.80 per square foot for the lifetime of the building. Recently, in 2021 and 2022, they've made inflation adjustments. So for buildings placed into service in 2022, the maximum deduction is actually $1.88 per square foot, again, for the lifetime of the building. However, with the Inflation Reduction Act of 2022, the deduction ranges have changed a bit. They've gone from $1.80 per square foot maximum to $1 per square foot maximum, sliding scale from 50 cents to $1. Now, the exciting part here is that if certain prevailing wage and apprenticeship program requirements are met, that deduction maximum goes to $5 per square foot. And again, we'll touch on what the prevailing wage requirements are here in a little bit, but the punchline here is this substantial, almost triple increase in the maximum deduction available for an eligible building. So getting into some specifics here, excuse me, some changes to the modeling standards and methodology. One of the big changes that are part of the Inflation Reduction Act is the removal of a so-called partial allowance. So up until 2023, an individual building system may qualify for a partial deduction, whether it's interior lighting, HVAC, or the building envelope of the building. So if I go and replace all the light bulbs in the building, I can do just a lighting analysis and claim up to 60 cents per square foot for affected area of the building. That has gone away as part of the Inflation Reduction Act. So beginning in 2023, we must analyze the entire building as a whole, removing both partial allowances, but also the interim lighting analysis, which unfortunately does remove the ability to analyze parking garages. So we know there's been a lot of large deductions taken against parking garages, and those still will be available for buildings placed into service 22 and prior. But again, starting in 23, we'll have to focus only on conditioned spaces. So while we are losing the ability for a partial deduction, there is a new way to calculate them on a sliding scale. So previously, a qualifying model was one that calculated a 50% annual energy cost savings year over year compared to the ASHRAE baseline standard. That has now reduced down to 25%. And starting at 25%, an eligible building will receive 2 cents per square foot from a sliding scale 25 to 50%, which equals a savings of between 50 cents and $1 per square foot. That shoots up to 10 cents per square foot if prevailing wage and apprenticeship program requirements are met, to a maximum of course, $5 a square foot, with $2.50 being the minimum. Now, there's been some back and forth over the past few years on the modeling methodology, what ASHRAE standards are to be used, et cetera. And the Inflation Reduction Act finally kind of addresses those in a clear way. So beginning for buildings placed into service in 2023, the new standard will be the most recently approved ASHRAE 90.1 standard 4 years prior to the building being placed into service. So what does it mean to be approved? Not only does the ASHRAE standard 90.1 need to exist, which is updated every 3 years, but also it needs to be affirmed by the Secretary of the Treasury. And to date, the most recently approved standard is 90.1 of 2007. So going into next year, we will still model a building against ASHRAE standard 90.1 of 2007. So as you can imagine, given the updates in HVAC technology, especially LEDs as well, we're comparing a newly constructed building to a pretty old standard at this point. Now, that will change as the Secretary updates and approves newer standards. We will be forced to model against a more recent, most likely 2016, maybe even 2019. That remains to be seen. But for now, again, it is 2007. So good times for energy modelers.
Thank you, Bill. One of the areas that I mentioned is underneath the Inflation Reduction Act of 2022 was not only the increase with respect to the 179 Cap D opportunity, almost tripling it from the $1.88 up to $5 a square foot. But it also expanded the eligibility specifically in the A and E space. So previously, when you thought about 179 Cap D and the energy design firm of record, if we were dealing with a governmental entity, those governmental entities being tax exempt were eligible under the statute to transfer that deduction to the applicable energy designer. So this is where 179 Cap D and the IRA of 2022 is really expanding the 179 Cap D benefit. So now it's expanded to certain tax exempt entities. So when 179 Cap D originally came into the statute, from a historical perspective, it came in underneath the Energy Policy Act of 2005. And it was only for a 2-year period, and then government evaluated. And so it kind of came in and out of the statute until the CARES Act, as Bill mentioned, when it was made permanent in the statute in 2020. And again, now permanent all the way through 2032. But it expanded to certain tax exempt entities, specifically for architectural and engineering or the energy design of the system. So now any level of government entity is eligible to transfer that deduction to an AE firm. Indian tribal governments also now may transfer that deduction. And then certain charitable organizations which are covered in the statute, 501c3s and churches and private schools and charities and not-for-profit hospitals may now also, underneath the Inflation Reduction Act, transfer that deduction to the energy designer of the energy efficient system, predominantly A&E firms. Now, it is very important to note, and we'll talk about this further, that there has been some recent guidance given in the June timetable in regards to the Audit Technique Guideline attributable to 179 Cap D. We'll speak about that further in the presentation. There's also some expansions as well, and Bill touched briefly on this, but when you think about 179 Cap D, there's also what is referred to as an alternative deduction calculation. So what does that mean? Basically, it's available if the maximum deduction is not originally calculated as you're evaluating the building. So after modeling, the balance of the dollar square foot, remember that 50 cents to a dollar, or then the $5 a square foot, which we'll speak about prevailing wage as well as apprenticeships program, can be calculated under an alternative method. The point here is that under the Inflation Reduction Act and the expansion and the enhancement of the deduction, they really want taxpayers, whether it's the developer of the asset or whether it is the owner of the asset, to enjoy the benefit of the energy efficiency deduction by either using the standard or using the alternative method. Now, we talked a little bit about retrofits. So when you think about a qualified retrofit of an existing building, it still must reduce the energy use and the intensity by that 25%. So remember the old standard, which we'll highlight a little bit, was 50, and as Bill highlighted, it's new at 25. Also, upgrades must be part of the qualified retrofit plan now. So there has to be a written plan to reduce the energy intensity as part of that renovation of an existing asset. And it also must be certified by a licensed architect or engineer when we think about the retrofit plan, specifically if it's a written plan. Now, in this case, the building must be at least 5 years old at the time of renovation.
And Ron, I'd like to jump in real quick and just highlight the kind of a major difference between the two programs or the two calculation methodologies. One being kind of a hypothetical, where we're comparing a prospective building or a design against an old standard, in this case, ASHRAE 90.1 of 2007. This plan or this program will allow a taxpayer to actually compare energy usage, energy bills, as well as other forms of consumption that we can track year over year, and actually compare a building against the new building once the upgrades have been put into place and enacted. So a little bit different there, but the opportunity here is for a taxpayer to take advantage of this 179D deduction multiple ways, and they're quite different in how that's calculated.
So as with all tax legislation, it doesn't really get simpler in the process, but there is some complexity to it underneath the Inflation Reduction Act. But from a policy perspective, to Bill's comment and my comment earlier, the intent from a clean energy, sustainability, green energy is really to help subsidize the taxpayer, whether you're a developer or an A&E firm, to incent energy efficiency. So that kind of brings us to also some updates. So there's also now what is referred to as a periodic reset of the available deduction. So what do I mean by that? So previously 179 Cap D was really a one and done. You were only available or only eligible to use the 179 Cap D energy efficiency deduction one time during the entire life of the building. Well, they've expanded that now. So now every 4 years, it really resets to where you now can claim the 179 Cap D deduction again. the deductions, in fact, are now aggregated over a 3-year period. And then again, that new deduction or that new 179 cap D is really reset after that 4 years. And it specifically applies as well to deductions allocated from tax exempt entities. So let's walk through an example. Bill, why don't you walk us through an example of old law versus new law and the impact of 179 cap D?
Sure. And we created this little table here to really illustrate the incredible differences between 2022 and previous and 23 going forward. And to Ron's point, just how much Congress wants taxpayers to take advantage of these deductions. So, first thing on here, the ASHRAE standard has not changed. And again, I do want to stress that it will, but at this point, it is still 90.1 of 2007, so quite an old standard. That minimum qualifying threshold has now dropped from 50% down to 25%. So a partial deduction or a smaller deduction, still larger than the largest deduction you could claim for a building placed into service 2022. So on average, if we look at a 100,000 square foot building previously, a maximum of $188,000 for that building jumps up all the way to $500,000 in potential deductions, provided again that the prevailing wage and apprenticeship programs are both met.
Fantastic.
Yeah.
So as you can see from Bill's running us through that example, it is a substantial benefit when you think about the movement effective January of 2023. So let's now chat a little bit about the Audit Technique Guideline and 179 cap D. So as I mentioned, new guidance, for those of you who are familiar, the Internal Revenue Service issues not annually, it could be 10 years as it was here between Audit Technique Guidelines. But in the event of an examination, specifically given the magnitude of the change from $1.80 to upwards of $5 a square foot, there is a audit technique guideline that an examiner would use in regards to 179 cap D. Now, this was issued in the June timetable. We simply wanted to mention this to you so that you were familiar that it was out there. But what we would expect going forward, given the federal subsidy and the magnitude of the deduction, is that we may see more and more examinations attributed to 179 cap D. That is in no way to cause a concern in regards to this presentation. It's just that, as I mentioned, tax law doesn't normally get simplified. It gets more complex and attributable to the dollars involved in the energy efficiency deduction or 179 cap D. The service wants to ensure that the applicable compliance is there from a taxpayer's perspective, as outlined in the example that Bill went through, just simply the magnitude of moving that deduction from $188,000 to $500,000. So some more complexity, but for a $500,000 deduction on a candidly 100,000 square foot building, it's pretty powerful, and they want to make sure that it's doing it correctly. So from a 179 cap D perspective, what we wanted to do is just kind of summarize it. So changes effective beginning January 1 of 2023. Again, increase in the maximum availability of the deduction, now qualifying $5 a square foot. However, that's an asterisk of prevailing wage and apprenticeship programs, which we'll touch on. An expansion of eligible buildings. Now tax exempt entities can allocate a 179 cap D deduction to the energy designer, and that is also for churches and charities and hospitals and private schools, et cetera. So again, an expansion and not only the increase to $5. The triennial reset, as we refer to it. So again, every 3 to 4 years, relevant upgrades to the building must have been made in that time period, and then you're eligible for not just the one and done 179 cap D, but you're eligible for 179 cap D again. Now, this is where we want to make sure we highlight the asterisk. There is now a prevailing wage and apprenticeship program requirement to get you to the $5 square foot. ultimately that project, that construction project, or that renovation must have paid prevailing wages based upon where the asset is located, as well as there has to be an opportunity to utilize, predominantly from community colleges, some form of an apprenticeship program to train individuals with respect to an energy efficient building. So this is very important to achieve the $5 a square foot. So let's now move into 45L, and I'm going to pass it back to my teammate, Bill.
Thanks again, Ron. So very similar to 179D, 45L is structured to address the energy consumption of residences, homes, both single, multifamily, as well as manufactured homes. So you could look at 179D and 45L being kind of sister incentives in that they were introduced at the same time, both meant to address energy consumption and ultimately reward taxpayers for the design and construction of these energy efficient facilities. 45L, of course, the major difference being a tax credit versus a deduction. And that will go on to have some impact on who can take it, how it's applied, et cetera. And we'll get into that detail here in a little bit. But it had recently lapsed. But as part of the Inflation Reduction Act of 2022, it had been extended both retroactively to include tax years 2022, but also include a 10-year extension, major changes of which will take place for buildings placed into service January 1, 2023 and later. Again, most excitingly, very similar to 179D, an increase in the maximum available credit, more than double, as well as pretty large changes to the energy efficiency standards, how the credit is ultimately calculated. We'll talk about that in a little bit. And very similar to the previous ones, requirements for prevailing wage and apprenticeship requirements program. So what's the big change? Previously limited to $2,000 per qualified dwelling unit. What is a dwelling unit? Well, for a single family home, that's a single dwelling unit. For a multifamily building, such as an apartment building, each individual apartment, condominium, what have you, is considered an individual dwelling unit. So previously $2,000 per door is the way we like to address it. However, starting in 2023, the maximum available credit will increase to $5,000. So again, more than double the previous credit. Now, to reach that $5,000 in maximum credit, similar to 179D, a multifamily construction must meet prevailing wage and apprenticeship requirements. There are no such requirements for single family and manufactured homes. So the prevailing wage and apprenticeship requirements will only apply to the multifamily. Now, one major thing to consider with the prevailing wage and apprenticeship requirements is that while they have been described in the Inflation Reduction Act, at this time, the Secretary of the Treasury has not yet finalized requirements as well as enforcement methodologies for the prevailing wage and apprenticeship programs. What that means is that until such time and for 60 days after, any project that is currently in process right now will not need to meet those requirements. So, and Ron, maybe you can jump in. When do we expect to hear from the Treasury as far as finalizing those requirements?
You know, based on our discussions with the Department of Treasury, first, they have asked for consultation and input from practitioners. Those comments are to be delivered back by March. The general view is that we will not see the regulations that outline prevailing wage as well as apprenticeship programs in detail to taxpayers until probably the latter part of 2023. So to your point, right now we're in this window of opportunity that you can qualify immediately for the $5,000 max, and as well as the $5 a square foot underneath 179 Cap D. As we talked about, there also are changes, so we're expanding. We touched on 90.1 2007 and 179 Cap D. So let's now talk a little bit about 45L and some of the things and the changes that are occurring to give you some background here. So effective January 1 of 23, now we are modeling energy efficiency underneath what is referred to as the STAR program, which some of you may be familiar with. But ultimately, the residential or multi-residential, to earn the credit, the building has to meet the national and local Energy Star requirements, depending on when that asset is. And again, this will be updated. Requirements will update again in 2024. But we know that the DOE program, or Department of Energy, Zero Energy Ready Home National Program, just made an announcement literally November 1st to give us some initial guidance to ensure that we can qualify for that $5,000 per unit. Remember, it's 2,500 unit maximum available under that Energy Star. And then you kind of get underneath what's referred to as the Zero Energy Home Ready Home Program. You get up to that $5,000 if you use a prevailing wage and apprenticeship requirements. So there is some complexity here that we wanted to highlight for you. But again, to the November 1st announcement that came out, basically it indicates to us that a home shall meet the minimum requirements which are specified with regarding field testing by a verified worker. So that's where Cherry Bekaert stands to assist in the certification process. If you really look at the Department of Energy guidelines they just put out around a zero energy ready home and what they refer to as the mandatory requirements, really for all what they call labeled homes, there's really 7 areas that they're going to be looking at. First, the Energy Star for home baseline, which is basically being certified against the Energy Star Qualified Home Program. They're going to look at the envelope. Specifically, they'll look at ceiling, walls, floors, and slab and insulation. They'll look at the duct systems. They'll look at the water efficiency systems, the lighting and appliance systems. And then they also are focused on indoor air quality, which is something that's new. That's the movement to the STAR program. And then finally, there are some provisions in there to what are referred to as renewable ready. So in the event that a solar array were to be placed on a residential unit and or a multi-residential unit. So just to give you a sense here, the changes, 2022, we were dealing with a different standard, the 2006 IECC standard, credit 2000, example of 50 units, you got a $100,000 credit. Now we move into 2023, again, with that asterisk of prevailing wage, as well as the apprenticeship program. We're looking at that Energy Star or the Zero Energy Ready Home, as I mentioned. Now the credit base $2,500, but focused on the $5,000 per unit. And that's where that reset occurs in 2024 because we'll have additional guidance. So now we're setting up about $100,000 credit to the developer. We're looking at a $125,000 to $250,000 credit, upwards of a $500,000 credit. So very impactful by the numbers, which brings us to our polling question number 3. So with recent changes to the energy incentives, how likely are you to reevaluate from the standpoint as part of this tax strategy for you from a development perspective? A is likely, B is unlikely, C is we already take advantage, at least under old law, and we'll likely continue to take advantage, but you probably need to reevaluate. All right, we'll give you another minute because we are anxious to get to our panel and our guest speaker, who we are very fortunate and to brag on him a little bit. Their firm is the #1 and was recognized as the #1 A&E firm in North Carolina. And so we're very proud to have Victor with us today. So polls closed. So again, what we'd like to do, Bill, you want to summarize for us what we've learned in 45L?
Sure, sure. So, obviously went through a lot of detail here, but some of the salient points that we want to focus on, of course, these will take effect for buildings placed into service January 1st, 2023, and later up through 2032. Very quickly, what does it mean to be placed into service? For the purposes of 45L, a unit or home has been placed into service on the date of its initial lease or sale. So keep that in mind when you're developing your new properties. The increase in the maximum available credit, which is of course now $5,000 per unit. A very exciting thing for us is the removal of a height limitation. So previously, a multifamily building for 45L was capped at 3 stories above grade. That has gone away, and so now we can look at high-rise condos, et cetera, which is an obvious change to make if you want to incentivize energy efficient construction. So the other big changes here are the updates to the energy efficiency standards. Previously, the IECC standards for 2022 and prior will go away in favor for Energy Star, as well as the Zero Energy Ready Home certification. So Zero Energy Ready Home being essentially Energy Star plus some additional room for renewables, as Ron mentioned. Excuse me. And then finally, again, the new prevailing wage and apprenticeship program requirements, which Ron touched on. And again, those won't go into effect until sometime next year.
So that brings us to our last polling question before we go into our client panel. Would you like to learn more about how 179 Cap D and 45L and how you can take advantage of it as a either developer or an owner of an asset, or certainly an A&E firm, given the expansion of the transfer to tax exempt entities? And again, the takeaway should be movement from 179 Cap D to $1.80 to potentially $5 per square foot. Gave you an example of that. And then in 45L, the expansion from $2,000 per unit to $5,000 per unit. And we gave you an example of that. So we'll give you a few more minutes to complete this poll. And then we want to make sure we get to our client panel and have a robust discussion of what all of these changes mean, not only to an A&E firm, but what does it mean to the real estate community as a whole? All right, well, thank you for taking our last polling question, and the results are in. Well, what we'd like to do now, as I mentioned, is transition into our client panel. And again, I was bragging a little bit earlier in our webinar in regards to Victor Jones, but Victor has joined us today, and he is the managing partner of really the #1 A&E firm in North Carolina, Jenkins Peer. And we're very thankful to have Victor with us today. So Victor, many have referred to the Inflation Reduction Act of 22 as really a game changer for A&E firms, not only from the standpoint of the design work that you will be doing with your clients to ensure they can take advantage of these benefits that we've discussed and the expansion of the benefits, but also obviously A&E firms can benefit significantly. So, what is your view in regards to the act and how that will impact not only your clients, but how it will impact you all as an A&E firm?
Well, for our private clients and multifamily clients especially, we're going to we're going to make sure that they're aware of the 45L program, because it's going to help them with their performance for how they get a project built with higher interest rates now. If they have that information in front of them, it's going to change things. And also as we design, it's going to be important to to make sure we meet the parameters so that they can take advantage of those credits. I guess in the past, we do a lot of private higher ed work in the past, we haven't been able to take advantage of the energy efficiency. I can think of one project. We renovated a 100-plus-year-old building at Agnes Scott, Rebecca Scott Hall, and we renovated it to LEED Platinum standards, and so it's a LEED Platinum building. It's a 100-year-old building, which is pretty impressive. And we were not able to take advantage of that. Well, now we're renovating their main hall building. And so when we get to the end of that, we are going to be able to take advantage of the 179D deduction. So that's a new thing. This is not why I went to architecture school, but in the spirit of doing what's in the best interest of the business, these are big things for us, especially when we're getting $5 a square foot deductions. So it makes for interesting tax planning. It's very exciting, and on a corporate level, it certainly does a huge amount in terms of reducing the taxes.
So when we think about your firm and other firms, because really you start with the design concept, and within that design concept, your client is asking you for certain features and amenities from an A firm perspective. So as all of these energy deductions and the credit that we've talked about today, do you think that's going to ultimately change your process as an A&E firm, not only in the private clients that you represent, but also with respect to yourself, specifically in regards to the expansion of tax exempt entities as well as churches, and to your example, where ultimately a project didn't qualify before, now it does. So really, do you see a lot of process change for the A&E industry as a whole, given the magnitude of the change of 179 Cap D and 45L?
Honestly, I think a lot of the industry is really unaware of the previous value. I think that they are going to pay a lot more attention, and I think it's going to be a lot more eye-catching, to them in terms of something to pursue. I do think it's going to make big changes.
Now, I know that A&E firms often get requests for proposals. So over the horizon, obviously, to your point, private clients and or A&E firms likely did not take advantage of this. So do you think that we're going to see, or you're going to see, more questions to you as the A&E firm and the designer of a building with respect to, hey, what are all of the things that I could be eligible for, and what do I need to do from the private side or a public side to make sure that I'm maximizing these? So do you think those are going to be started to be in requests for proposals that you receive?
When developers understand the value of this, they're definitely going to want to take advantage of it. Most developers I know would want to do only what they need to do to get to the maximum amount, but that's great. It's doing what it's intended to do at that point.
Yeah, well, as you know, we found from a Cherry Bekaert perspective that really it is a game changer in regards to A&E firms, where a lot of A&E firms will utilize outside firms who have energy practices as we do, to really almost on the front end of a design project, to also help and assess with the architectural firm, here are things that should be considered to make sure you're maximizing that deduction and maximizing that credit. So one of the areas that, at least in our practice, we have found interesting is, can you give us some explanation and background? So we utilize these terms of ASHRA, and we showed the slide of 90.1 2007, and then that, at least for a temporary period of time underneath the Inflation Reduction Act, is the same standard. But I think it would be really important for our listeners today and on the webinar to really understand what that standard is, and is it a current standard, an out of date standard? And as a A&E firm, what your requirements are with respect to that ASHRAE standard as you're, ultimately drawing and designing the asset.
So I'm not a mechanical engineer, but the ASHRAE standards that we're held to right now are much more contemporaneous. Anything we would permit would far exceed the energy requirements of the 179D program as it is now. So typically we get the full deductions for any of our projects. And so it's really easy to get them. And most architects, I think, are completely unaware of it.
Well, obviously would agree with that. And so when you think about permitting and actually receiving a certificate of occupancy, is it a fair standard just to draw kind of a comparison that, if you were to design and architect a building at that 2.07 standard, the likelihood of you getting the permits and likelihood of that asset ever being placed in service is highly unlikely. And we often find that, I'll say, developers and your clients, as well as A&E firms, really, don't understand how low the threshold is to earn that 179 cap D deduction.
Right.
Right. So let's move to some questions, and I'm going to ask my teammate to answer a few in the 45L space. So, Bill, if I'm the developer of a new home or a multi-family building, but I immediately sell that building after the completion of it, can I still claim the 45L credit? How does that work?
Absolutely. So 45L differs from 179D in that it is meant for not necessarily the end user of the building, but for the developer. That is someone that's got a financial stake during the construction of the project. So even if I immediately lease or more importantly sell the unit home, manufactured home, I am still the one that's eligible to receive that credit. So that's what it is meant for, are the people that are actually, again, developing those properties. So we see companies take advantage of it from developer firms, general contractors, so long again as they have a financial stake in the project, all the time. The one exception would be if I'm an owner of a home and I had it built, from the ground up. I hire the architect, I hire the builders, and I'm the one spending the money. That is a rare occurrence in our experience. So absolutely, long story short.
Yeah, we found this in our practice, and that's why I wanted to cover it in the question, was that a lot of developers don't necessarily, especially in this market where, depending upon where the development was or the asset was being constructed, they chose to go ahead and sell it because of just simply the increase. If you saw a facility in Austin, Texas, or Miami, and I could name another, but the key there being is it is a credit for the developer, and you earn the credit when you sell, lease, or rent the unit, and that is what drives it. And we are likely to see that continue, certainly as the 45L credit has been expanded upwards of $5,000. So Bill, let me ask another question. So, we've kind of talked about 45L and that kind of renovation, and it's no longer, you kind of also have the opportunity to look at it. But can a building that's been renovated or converted into a residential space, could that also be eligible for 45L?
Yes. So the title 45L being the new energy efficient home credit is a little bit misleading. Luckily for us, though, the language does go on to clarify that new construction can also mean substantially renovated, quote. Substantially renovated being gutted. Often we see down to the studs. Any facility that's been converted to multifamily can absolutely qualify. The important thing to keep track of is, are you adhering to the guidelines starting in 2023, Energy Star, if you want the 2500, and then the Zero Energy Ready Home program, if you want to get the 5000. So long as you meet those requirements and the building has gone through a arguably substantial renovation, yes, absolutely, you can qualify.
And the reason we wanted this question to be covered was we get a lot of questions from ultimate developers who are looking at, you know, a abandoned, let's say, textile facility, you know, being in North Carolina, and they're going to obviously renovate that structure completely and turn it in to whether it's a multi-residential facility or it's a multi-use facility, but there's going to be some home ownership or apartment type within that total renovation of a textile, you know, traditionally manufacturing facility. And so you are, in fact, to Bill's answer, eligible for the 45L upon the renovation or the conversion. So with all of these changes, and this really is to both Victor and Bill, is at what point in what I'll say the design concept or the development project should we really start reviewing the opportunities for 179 Cap D and 45L? And Bill, I'll start with you and then go to Victor.
Sure. So look, there's two large things to consider when preparing for one of these projects, and if it's going to qualify for 179D or 45L. The tax implications, and I know Victor's got that in his mind, so I'll let him cover that. But the other half is, will the project qualify? Especially now with the new requirements for 45L, they are more straightforward than previous, but also more specific. There are things that the building must have to qualify for the Energy Star rating, but in addition, the ZER, the Zero Energy Ready program. Is the roof able to hold up solar panels? Did you install an inverter for potential solar panels? But also, does the fenestration contain Energy Star rated windows, things like that? These are things that we should start reviewing with you early on the development. So I would say the earlier the better for, again, tax planning, but also let us review your design with you, and we'll give you some guidance as to whether or not it will qualify under the new standards.
Victor, are you of the same mindset from the A&E side? Is the sooner the better, specifically given all of the changes that have occurred, specifically in the two areas that we've talked about today?
Absolutely. It has a overall financial effect for the project as it relates to our clients, and for the projects that we're doing. It has a direct effect on us for our state, federal, county projects. So the sooner you understand variables in a project that you're designing, it's like variables that, if you want the net outcome, you really need to be focused on it up front. So even from, we in concept design, before we even put pen to paper on a lot of things, we'll have a narrative. Like we'll have a mechanical narrative, we'll have a window narrative, we'll have, there's narratives for every piece of the project as it relates to cost. And we have cost estimates that have very, very little drawings and a lot of narrative. Well, it's still real cost. And so we're cranking those things. And from the very beginning of projects, we're actually working, we work with our clients to size up, for example, a county project we have is a renovation to a recreation center, as an example. And right now we are finishing up concept design. We have shot for the moon in concept design, and we have a list of like 100 things. Well, we've designed to way more than their budget. What we'll end up doing is paring back as we enter schematic design. We'll pare back to 90% of the construction budget, with add alternates that go up to 105%, so that we can hit our client's budget. And at the same, and so these things have to be there. And if they're not in there, and you start schematic design, well, when you get to design development, if you haven't if you haven't factored these things in, then, you know, you're going to be, your mechanical engineer and everything else can get thrown into a chaos. So it has to be factored in from the beginning.
No, I think that's the key. And thank you, Victor. And let me also say thank you to Victor as our client panel, a lot of great insight and obviously a tremendous experience. And, you know, your firm is well, the premier firm in North Carolina. And we appreciate you taking time out to join us today. I'd like to thank those, all of you who attended our webinar today.
Thank you, Ron, and thanks again to all our speakers. That concludes our session today. Thank you again for joining us. And if you have any questions, please reach out to us at any time. And we do value your feedback. So we ask that you take part in a short survey, which will appear once you leave the session. And thanks again, everyone. So Bill, Victor, and Ron, thank you.